Welcome to the Bitcoin Macro War Room, where we jack into the market mainframe and derug the narrative. Plug into the pipes, M2, DXY, inflation, momentum, fresh prints, CPI, ISM, payrolls, rates, truth by facts, not vibes. Tweets and news rundown, meme to policy, curated, timestamped, tradable.
Welcome, you've got mail.
Copium not included. Roll the tape, let's invest like it's 1999, but with better charts.
It's Friday. You know what that means. We've got another Bitcoin Macro War Room episode on deck. My favorite video to do every week, breaking down the data with you all and seeing what's going on with Bitcoin, where are we heading, and most importantly, what does the system say? And I have a few important and fun updates, so stick around towards the end. But let's dive into it. As we always do, we'll start off with the charts. So taking a look at this, first thing that jumped out to me was global liquidity. So the M2 line here, still trending higher, albeit slowly, still risk on for the liquidity regime. Those are all positive signs. For the macro overlay tracker down here, we're back to cycle phase neutral. As you can see, this has kind of flattened out a little bit, but the score is still positive. All the subcomponents are still positive. The only two negative ones here shown are the Meyer acceleration and the net liquidity delta, because this has kind of stalled out recently. But overall, nothing too much has changed from last week. I think the one thing to note here is you can see I drew a red dotted trend line on the bottom. We've been trending up since April 2024. And I think that this is just going to continue into Q2 of 2026 next year. And there's still a lot of room to run. And we're going to look at the data because I think the data shows that pretty clearly, if you ask me. So here's the quick rundown. It wasn't too crazy of a week in terms of data. You had the producer price indexes, which is the PPI here, and you had the CPI, which was the big print this week, which is the consumer price indexes, and they all basically came in line for CPI outside of month over month, which had a 0.1% increase. But I think the big takeaway here was the PPI numbers, because they actually came in under the forecast. This is a good inflation hedge, and a negative print shows us that inflation isn't accelerating as much as people generally think, which gives the Fed the green light to continue easing and potentially end QT officially, which we'll get into in a little bit. But this is supportive of a softer dollar, and it gives more juice to the liquidity positive narrative. For CPI, this is the sticky services type of bullseye for the Fed. It's the cleanest gauge of underlying inflation, if you believe the numbers anyway. Inline, which is the prints that we basically got, keep the narrative steady, in my opinion. So nothing too crazy here. I mean, the unemployment claims, which is the fastest read on layoffs, did exceed the forecast by about 30,000, which shows that labor continues to cool. The markets are just going to price in more easing for the Fed. Again, this is a dollar negative, which is good for risk assets and Bitcoin. So this is a positive in my view. For the consumer sentiment, again, we missed by a little bit. This is just a survey of confidence from households and inflation expectations, like 1 year, 5 year. It signals strength of consumption, right? So weak sentiment, again, is just positive fuel for liquidity and the green light for Fed easing. So that's it for the data. I think next week, all eyes are on next week, because we will have the federal funds rate being released on Wednesday at 2 p.m. That is the biggest piece of macro news for the next week, and all eyes are on whether or not the Fed cuts 25 basis points or 50 basis points. So I know we looked at this last week, and a 50 basis point cut was about 15%. It's now dropped to about 7%. So the overall sentiment here is that they're going to do one cut, 25 basis points. What I thought was more interesting here, though, for the Fed projection tool was October, because there is an 80% chance now of a second 25 basis point cut in October, which would bring the total cuts to 50 at that point. And then for December, there's a 75% chance of a third cut. So if you look at the probabilities in aggregate, this again continues to skew to the left, which is obviously bullish for risk assets, Bitcoin, etc. The Fed is not cutting into a recession like it historically has done. The business cycle is still early. And I'm actually going to pull up a chart that I put on my X earlier this week that basically describes my whole thesis. So let me move my camera here to somewhere that makes sense. Maybe I can zoom this out a little bit so you can see. This is my entire thesis summed up in one chart. You got Bitcoin on the top, you have the ISM on the middle panel, and DXY on the bottom. And you can see for previous bull market peaks for 2011, 2013 to 2014, 2017 to 2018, 2021, etc., all peaked out when the ISM was above 55. Let's say we had that one weird cycle in 2013, 2014, and the DXY was weak, right? This is inverted here on the bottom. And this cycle, as you can see, the ISM in this orange box has been sub 50. I've been harping on this weekly in these shows that this is one of the longest stretches of the ISM being below 50 in its history. And once this actually breaks out, starts to expand after the Fed fund rates cut, boy, I think a lot of people are going to be left sidelined. I think a lot of people are going to be caught chasing. I've seen a ton of the cycle is over, the top is in type of calls on my feed, and I just don't think that's true. And this chart shows it. What has helped this cycle so far in terms of how far we are off the bottom is the weakness in the dollar and global liquidity increasing, but not from the US, more from China, EU, and other nations. So that's my thesis at a high level. With that out of the way, we will get into what you're probably here for, which is the system. So taking a look since last week, this has dropped to 81%. I think last week we were at 98%, but do not worry. It's not a big deal. The only two things that changed were these inputs, which is the regime tracker we just looked at and the global liquidity M2, which we also just looked at on that chart. They both went to neutral from bullish just because the trend currently is not pointing up. It's not accelerating. It's just kind of stuck in a chop zone. Both of these scores lowered the score to 81%. And also the MVRV score went bearish. But I'm about to show you why that doesn't really matter, because as of today, and if the price holds where it is, it's going to flip back to bullish. So don't put too much stock in this. We're still risk on. The cycle continues. I'm still fully invested. And we'll move on to the on-chain data. And here's the surprise, I guess. Maybe not surprise, but just some good, maybe good news. I've been working on my own site. So I know we've been going over the Crypto Quant dashboard every time. And I kind of just, it's slow. It lags my browser. It doesn't have exactly how I would lay out these charts. So I rebuilt this myself. And this is free. If you want to use this, please, more than welcome. Go ahead. That's why I built it. The link is in the description. It's called DurdenBTC.com. And basically, this is all the charts that I look at on my Crypto Quant on a daily basis, but on my own site with my own data sources. So I use the FRED, which is the Federal Reserve's website, and also a direct API to on-chain data to build out these charts. So instead of going through the Crypto Quant, we're just going to go through my charts that are also basically these 5, 6, whatever indicators. And we're going to start right off with the short-term realized price, right? This is basically the line in the sand. You can see if I zoom out to all how this kind of has performed over the last couple of cycles. And it's done really, really well as a long-term cycle investing tool. So if we zoom back into 1 year, we are still bullish. This flipped briefly negative. And again, during bull markets, this is a great place to DCA when this actually flips negative. Again, we still have some time left in September. So keep your pants on for now. We still might have some volatility. I'm waiting for the rate cut next week to happen and to see how the markets react, whether that's a sell the news or a rip it higher type of event. So that's it for STH. For the DXY trend filter, again, this is the same thing as this DXY bull signal chart. We are currently still bullish, right? Because the dollar continues to be in a downtrend. For the MVRV score, this is the one that flipped negative on the system. You can see how it's performed over the course of the cycles. If we zoom in a little bit, you can see it did go risk off, but looking at this bottom panel, which is how the score is calculated, it is right there. It's just about to flip back to positive. So I wouldn't put too much stock into that score, and I wouldn't be worried at this point. There's some other interesting charts here that I would like to take a quick look at. The most important one, I think, is the Fed Net Liquidity Z-score. So you can see how this has performed over the entirety of all the cycles. Green background meaning risk on, red background meaning risk off. And if we zoom out to the latest cycle, you can kind of see where we've went risk off and where Fed liquidity has been muted. And this is specific to the United States. So this does not incorporate sort of China, Eurozone, etc. Most of this price appreciation has been led by those countries easing. The United States is kind of last to the party this cycle. And I think once we take a look at some of the tweets and some of the news that I'm going to share, they're about to start QE again. They're going to have to. And that's really going to open up the liquidity pipeline. And again, for the people that are sidelined, I feel bad for them. So it is what it is. We'll see if that ends up actually being the case. But that's where my money is. I'm going to put my money where my mouth is, and I'm staying long. That's what the system says. So we'll continue with all that stuff out of the way. I guess the only other one I wanted to share to reinforce this point about the U.S. liquidity being sort of muted is you can see on this chart, this is global liquidity M2 year over year. And what this is showing is the U.S. liquidity. So you can see on the bottom chart, it's been really muted this entire cycle. And that's because the Fed has been doing a kind of liquidity drip by selling short-term bills and not focusing on long-term notes. So this is the kind of 1 to 3 month T-bills versus the 10 to 30 year notes. They've been using the RRP for this, and that is coming or is going to have to come to an end. So we'll just jump right into the news section. And I'll start off with this from Reuters. Fed's balance sheet drawdown enters new stage as reverse repo is largely drained. The Federal Reserve's effort to shrink the size of its balance sheet is moving into a more uncertain phase as a key proxy of excess liquidity has been very nearly extinguished. Over recent days, cash flowing into central banks' overnight reverse repo has fallen very close to zero, capping what has been a long and slow grind down from a peak of 2.6 trillion. What this basically means is that Fed QT, right, which is quantitative tightening, now is colliding with this almost empty, shrinking reverse repo and having declining reserves. With repo friction starting to pop up, a lot of strategists, and I agree with this, are saying that they are going to be completely pausing QT. I think they have done so already, and they're going to actually reverse that and start QE again, which is quantitative easing. That is a huge liquidity tailwind for Bitcoin. So we'll take a look at some of the other stuff I had ready to share here. This is a insanely long tweet, so I'm not going to read it. Feel free to check out Alpha Extract yourself. They post amazing charts. But I think the most important thing to note here is that liquidity is what drives Bitcoin, not CPI prints, not just the DXY. It's liquidity, which is a combination of things. M2, the dollar, rates, oil, even gold. I mean, you have to look at this if you're going to be a macro-minded person at a 30,000 foot view. You need to zoom all the way out. So regardless, liquidity positive. I'm still bullish about the entire view overall going into next year. A great tweet by James here. Most people in this current cycle are capitulating based on time, not price. And I'll pause there really quick because I've seen a lot of these takes on my X that the 4-year cycle, this is it. This is where it's supposed to top, and that it's over. 122K was the top. We're never going back above. Bear market confirmed, et cetera, et cetera. This is all just crap. It's a crap take. If your entire analysis is based on, well, the 4-year cycle historically ended on this month, it has to end on this month. That is a low IQ take. I'm sorry. It just is. It's a low IQ take. Let me finish the tweet here before I go completely off the deep end on a rant about this. Bitcoin price in dollar terms has been great this cycle. The issue is most people need greater returns due to age, cost of living, impatience to chase the next thing, etc. As the cycle lengthens and returns get smaller, we are seeing irrational sentiment based on a standard 15% drawdown, which is all that this has been. Most people will capitulate due to time, not price. I couldn't agree with this more. Let's keep going. Again, this is something I've said, but Donnie here, I think, nailed it. The Fed is about to cut into rising PMIs. I think the labor weakness isn't a true slowdown. It's pretty clear we're transitioning to a new age of productivity and how we do business. That is AI, and that is completely true. That is not priced in yet fully in terms of the macro data. AI is cutting costs, boosting margins, and making the corporate giants that carry the U.S. economy more efficient than ever. And now even small businesses and entrepreneurs are scaling with AI. The productivity wave, cuts and other stimulus, QT to QE, growth, productivity gains equals turbo mode. The Russell is already sniffing it out with all-time highs, nearby and relative strength over SPX. The Russell is basically small caps. Small caps do or perform the best when rates are lower due to smaller businesses needing more CapEx and loans at lower rates. Typically, it has led all-time high breaks and BTC has followed. Again, love this chart. It's completely true. It is a almost one-to-one of what I'm looking at here with the ISM and the DXY. So Donnie, kudos. Shout out to you. Again, this is his chart zoomed in. So you can see, again, the ISM still below 50. Here's the Russell and here's Bitcoin. Beautiful chart. Love the styling on it too. All right. We already saw this. That's my chart. We already looked at the Fed's balance sheet. And I did want to share one video because someone actually, Tom Lee, of all people, said something very important about the ISM and what he thinks in relation to it.
I mean, that's a completely different story. You're looking at these Fed cuts as for good reasons, because we can do it and get away with it and it's going to improve the economy, or you're looking at this and thinking, I worry about what comes on the other side.
Yeah, I'm going to take the camp that I think that these cuts are actually going to be very constructive for the economy because the 30-year mortgage is strangulating the economy. We know housing has slowed dramatically, but we also know that there's a lot of pent-up demand for housing. So it's a market that does need to be fixed in terms of easing sort of supply-demand conditions. And we also know that ISM, which is a measure of business confidence, has been below 50 for 31 months. It's the longest stretch since the ISM's ever been created. So I think business confidence recovers if the Fed starts to cut. And so the combination of easing mortgage rates, business confidence recovery, I think is kind of a broadening cycle. And actually, I think that's why small caps have been the second best performing group after Mag 7 over the last 8 weeks.
I mean, he nailed it. He 100% nailed it. That is what is going to extend this cycle a lot further than people think. It is not over yet, at least in my opinion. I think the best is still yet to come, which is why I'm so excited to see how the end of this year pans out and what we're looking at when we start Q1, Q2 of 2026. I think the price is going to shock people. We'll see if I'm right or if I'm going to be left holding the bag, but the data is what it is. So I'm sticking by my thesis. That's all I can do at this point. I really hope this helped you maybe settle down a little bit. I know there's been a bunch of bearish sentiment on X specifically, which is generally always the case. So you have to take the good with the bad, take a step back and really look at what is your thesis overall. So regardless, that's another one in the books. Hope this helped you, maybe added some alpha to your life. And if you did like the video, if you made it this far with me, first of all, thank you for watching. I really appreciate it. If you did enjoy what you saw, you know what to do. I'm not even going to ask you for it. And as always, have a great weekend. I will see you next week for the next one. Cheers.